Wow, the Federal Reserve just used the R word. Let's talk about what was just said by the Federal Reserve, what it potentially means for the December meeting, and what data we just got this morning. In fact, let's start with some of the data that just came out this morning. You've got the whole Cloudflare outage, so X is having some issues. But this morning we got a report from ADP, our weekly jobless report or weekly job running report. It's a little different from the Thursday unemployment claims report that states and the federal government put together. This instead is the ADP report that says, hey, this is the 4-week moving average of what we've seen in the jobs market in October. And the ADP report that we originally got for October said that we gained about 40,000 jobs. A lot of those concentrated in the Pacific. Well, the 4-week moving average of jobs, which seems a little hard to reconcile, but the 4-week moving average of job gains ending November 1st, so basically October, was minus 2,500. Now, that's not good because it's negative, and it's certainly a lot lower than it's actually 42,000 that the original ADP report showed, which is suggestive that towards the end of October, we started seeing more layoffs, which we did. We saw a lot of corporate announcements, whether it was Target or Amazon or otherwise. But it's not like we're falling off a cliff. We're more appropriately close to this sort of stall in the labor market. And this is exactly what Chris Waller talks about. Chris Waller just spoke and talked about his opinion of what's going on in the economy. And yes, the R word comes up. So what we're going to do is we're going to go through the most juicy parts of his speech. We've got his transcript right here. So he describes his outlook for the U.S. economy. And he says that right now there's plenty of data that suggests we should be cutting. He says, even though we lost a lot of data, like are we actually going to get the October jobs report from the federal government? There's plenty of data to indicate the labor market today is near stall speed. This, by the way, totally reconciles with the ADP report we just got minutes ago. Inflation has also continued to show relatively small effects so far from tariffs, which is good. We expect some bump from tariffs one time, and then over time we actually just expect GDP to contract. That's generally consistent with how tariffs work. In the long term, they weaken the economy. Now, what he also says is that despite inflation for the last 5 years running above their target, inflation expectations are anchored. So people are hopeful that inflation will indeed get to 2%, even though we're not getting anywhere close to 2% right now. He also suggests that the reason he supports a cut is because of what he sees in the data now and how it's different from what he saw in 2022. Remember in 2022 when the Federal Reserve raised rates like crazy and crushed the economy? Well, they crushed the overheated aspects of the economy. We ended up having a stock market sell-off in 2022, but we recovered really nicely with a glorious Nike swoosh from the stock market in 2022, basically all the way through now. This was a prediction that I made back in 2022 that we would have a Nike swoosh style recovery, which we did, and it's been remarkable. And we always thought it would end in some kind of bout of euphoria. The question is, are we in a bout of euphoria right now that's turning? Or is this still consistent with this Nike swoosh? That's a little hard to tell, but we talk about it every single day in our Alpha Report. So if you're not part of our Alpha Report yet, make sure you join it over at meetkevin.com. You can use the coupon code NVDA and you could join that membership. You get lifetime access. You pay once, you get lifetime access. You get all 8 courses. You get the new course that's coming out totally for free. It's included. Every trade alert, every live stream, every Alpha Report. Check it out. Now, in 2022, Waller tells us that he had more trust in the Beveridge curve, than the Phillips curve back in 22. Why is it so important that he's mentioning this? He says that in 2022, he believed that because job vacancies were so high on the Beveridge curve, however you want to say it, that we would not end up seeing a spike in layoffs. that instead what you would see is the curve would relax. So you would see the Beveridge curve come down and you would see job vacancies come down. And sorry, I'm losing my voice a little bit. Too much yelling about.
Big pee-pee.
Yeah. But anyway, this is exactly what happened, mind you. So he was right to cite that curve, but that actually creates risks today. See, look at this curve. This is the Beveridge curve. On the left, you have job openings. And what he said is that, hey, if we end up raising rates, we'll be okay raising rates. We don't actually think that the unemployment rate is going to go up, which is the bottom part of the line. We don't think the unemployment rate is going to go up. We actually just think we're going to go from this very high level of job openings, and we're going to see this level go down. And if you use a level of this that actually looks at a post-COVID era, what you'll see is you've had this very weird move down of job openings right here. But you have not yet, and this is the sort of to come part, I think, of where he's getting, you have not yet seen the movement or normalization over to the right. So this magenta line has not occurred yet. We've seen job openings go down, which is exactly what he predicted in 2022. And he was using this curve to predict that he would be right in 2022, that we could raise rates and you'll only see a decline in openings. Well, now that decline in openings has happened. What's the next phase that this curve tells you? The unemployment rate's going to go up and you're going to normalize. And that's what he's implying. He's hinting that, if we get a normalization there, we're going to see recession. But he actually goes as far as using the word recession. And I'm going to show you that in just a moment. So he says that the Beveridge curve combined with the soft data, in other words, firms saying, I can't find workers, like we like need to fill jobs, that we have so many job vacancies, we just need to fill these. He predicted there wouldn't be a big layoff surge in 2022 that would lead to a rise in unemployment. And while there were layoffs, there wasn't a big spike in unemployment. Now he sees us in this no hire, no fire equilibrium. And he sees that jobs data has clearly weakened. He sees that economic data is weakening. Look at Home Depot this morning. Just look at Home Depot stock. It's down like 4 or 5%. Why? Because there's talk that consumers are not spending on big ticket items and that they're holding off on projects that they might otherwise do if rates were lower or the economy were stronger. Home Depot stock now down 4%. Not a great look into the consumer, which usually is about 70% of GDP, maybe a little less now because of AI spending. But AI spending doesn't necessarily translate to a lot of jobs. Anyway, in the absence of more official data, but with additional private sector forecasts and surveys, it now appears to me that economic activity is not accelerating and therefore tracking more closely with the weak employment data we've seen. Remember, he says stall speed. He's not saying we've fallen off a cliff, but he's saying, hey, maybe we should cut rates before we fall off a cliff. Because so far, consumer sentiment data and the longer trend of it over the last 6 months has been consistent with recession. His word. While over the decades, the survey has not closely correlated with short-term spending, large persistent drops in consumer sentiment over time have occurred heading into recessions. This is from the Fed. They're literally talking about, oh my gosh, we could be heading into a recession because this is the kind of data you would expect heading into a recession. He thinks that a slowdown in consumer spending, like what you just saw with Home Depot, has huge implications for GDP growth. And this downward move in the survey since July, about the last 5 to 6 months, since some of that data reflects June, and unexpectedly sharp low reading in October is dour, a dour view on consumers. He thinks that the stock market does not reflect the financial conditions of most Americans, and that while the AI boom is great for propping up GDP and stocks, it doesn't create jobs or consumer spending. Now, fortunately, because he believes tariff effects have been smaller than expected so far,
Little pee-pee.
he thinks that inflation expectations are anchored and therefore what we should focus on is cutting to support the labor market. He goes into his data to support this and essentially wraps up by saying we should be cutting 25 basis points. And there's going to be little that's going to change my opinion on that. Not even the September jobs data report, which is really backward looking at this point. And so here you now have the Federal Reserve blatantly saying the quiet part out loud. Data so far is consistent with us potentially walking into a recession. Now, what we're going to do is we're going to go put together our alpha report for the day, because we always do this before the market opens up. So we're transitioning right away to the alpha report. And if you want to be a part of it every single day before the market opens up, make sure you join us over at meetkevin.com. Thank you so much for watching. I wish you the best of luck out there. Stay safe. The Federal Reserve starting to ring the alarm bells, and maybe we ought to start paying attention.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.